In today's video, we'll take a look at what exactly lies behind the term working capital. The formula for calculating working capital is working capital equals current assets minus short-term liabilities. The target value for working capital should always be positive because in this case, current assets such as cash on hand, finished or unfinished goods, accounts receivable, and short-term securities should exceed short-term liabilities. A negative value, on the other hand, indicates potential payment difficulties, as the current assets are not sufficient to cover short-term liabilities. By the way, short-term liabilities are obligations with a remaining maturity of up to 1 year. All clear so far with the theory. Now let's take a look at this in a concrete example. We have been tasked with calculating the working capital for a car manufacturer. For this, the accounting department has provided us with the following values. The cash balance is $40 million, the finished goods amount to $300 million, while the unfinished goods are $250 million. Additionally, the company holds inventory worth $60 million. Accounts receivable amount to $25 million. Moreover, we are informed that the company holds investments in the form of securities, which it plans to hold only temporarily, amounting to $5 million. There are also investments in securities intended to serve the company's operations permanently, amounting to $10 million. Lastly, the fixed assets have a value of $800 million. All clear so far on the asset side. On the liability side, the accounting team sends us the following excerpt. Liabilities with a maturity of up to 1 year amount to $500 million, and liabilities with a maturity of more than 1 year amount to $700 million. Now we are ready to calculate the working capital. First, we need to calculate the current assets by adding the following items. The cash balance of $40 million, the finished goods of $300 million, the unfinished goods of $250 million, the inventory of $60 million, the accounts receivable of $25 million, and the short-term securities of $5 million. The long-term securities and fixed assets are not part of the current assets and are therefore not included. Thus, the current assets amount to $680 million, from which we subtract the short-term liabilities of $500 million, resulting in a working capital of $180 million. The company therefore demonstrates financial stability since the current assets exceed the short-term liabilities. Now we know how to calculate working capital. Lastly, let's look at one advantage and one disadvantage of the working capital calculation. A significant advantage is the very simple calculation of working capital. Just a quick glance at the balance sheet can already provide insights into the company's financial stability. However, a major disadvantage lies in the fact that working capital only examines the short-term financial situation of a company. A company with positive working capital could, for example, have extremely high long-term liabilities that cannot be covered. Therefore, the working capital calculation should always be supplemented with further analyses. We hope this video has helped you understand the topic of the working capital. See you next time and have a good one.